views in terms of the further catalysts, in terms of upside surprises for Europe?
Yeah, sure. I mean, the sort of has inflation peaked or not is really the trillion-dollar question I would say right now. And the way we look at the world and Europe is that inflation has clearly peaked there already. It's operating as a lag, certainly behind the US in terms of that particular cycle, but will follow suit shortly afterwards. The UK has a few of its own issues, and I think that's going to be a laggard still further there in terms of the rolling over of that inflation number. Most importantly with that, I think we see a rolling over, but we don't see a return to zero inflation. I think that's a very important question that asset allocators should be asking themselves right now. What does that mean for their allocations? Should they have as many growth stocks in their portfolio as they did in the last market cycle? I think will be pivotal for clients in terms of generating strong returns for their clients. In terms of other catalysts for European equities, I guess there's two really clear ones. Clearly, war on Europe's border is never good for risk assets, and the uncertainty that brings, as well as the clear humanitarian crisis that it presents as well. So if we see a resolution there, which is hard to call either way, I think that would be a positive for risk assets in Europe. And I guess the second thing would be Europe is very much a cyclical market by its nature. So as soon as we start to work our way through the second half of this year and begin to be able to gain a decent understanding of the depth of the recession that's coming, or indeed soft landing, hard landing, no landing. let's see where we end up there. And I think a lot depends on the actions of central banks over the course of the next couple of months. But Europe is a sort of viewed as a slightly more cyclical market than others. I think the next catalyst could be people beginning to be able to price this recession and say, actually, let's look beyond it towards the recovery. And then I think that acts as a very strong catalyst for European stocks and shares. And I guess when I'm looking at an asset class, I quite often bring it back to what we do day to day as stock pickers. So for example, in Europe, we've had a couple of chemical stocks report their earnings just before leaving the office last week. And they were pretty bleak results. But actually what you saw is a positive share price reaction from those names as the market said, okay, we've been expecting these results, we've been expecting them to be bad. Now at least we've got a bit of clarity and we can start modelling what that looks like and actually looking beyond it. So I think as we've seen that with stocks, I think you'll increasingly see people do that with the European asset class as well.
And since we are already into the catalyst of upside surprises, what about the major themes, if not, that you may see during this cycle in Europe?
Yeah, and it's a great question. You know, you can't have regime change without saying to yourself, what stock should I be owning in the next market cycle that is possibly different from the last? So maybe there's two main areas that I would point you towards here. First of all, AI. Everyone wants to talk about AI right now. And look, we're no different in Europe. We've got a number of benefactors of the move towards AI, not least through the obvious names like the semiconductor stocks. So we don't have the Nvidias of this world in Europe, but we do have the picks and shovels, the equipment manufacturers that actually feed someone like an Nvidia, and they're going to be huge beneficiaries of this very quick and swift move towards AI. But we've also got some of those sort of second order beneficiaries. So a number of stocks that we own actually operate heating and ventilation systems for data centers. So huge amounts of processing is going to be required for AI, huge amounts of data centers as a result, and actually keeping those cool in an environmentally and energy efficient way is an area that's going to attract capital over the course of the next decade, I think. So that's one area that I would point to. The second area I would say, and this is where our views have possibly firmed more recently over the course of the last 6 months, and that's around the nearshoring and onshoring of supply chains. You know, deglobalization is a theme that has been discussed for many a year, if not decades. But in the wake of all of the supply chain issues that a lot of companies saw after the COVID pandemic, increasingly from CEOs and CFOs, we hear them say, never again am I going to be stuck waiting for just one part or one component from one factory on the other side of the world from where I want to sell my goods. So we're actually beginning to see action being taken even ahead of a recession. Period typical for CEOs to say, actually, no spending, don't want to be outlaying anything ahead of a potentially weak demand environment. They're saying, no, I need to bring my production to Eastern Europe from Asia, or I need to move it to Mexico if I'm selling in the US. And there, I think we have a number of beneficiaries, predominantly through the industrial sector in Europe, that will be seeing a step change in their growth as this capex spending comes through. There'll be some losers as well. If you're having to spend that capex, you've got to do it in an efficient way. But there'll also be a huge amount of beneficiaries, and it feels as though we've got a disproportionate number of those in the European market.